Roger, thanks for joining us.
Always a pleasure, Peter.
Okay, so where do you think the market is right now? Because we've hit an all-time high on the awards. I know you don't particularly care about that. You're just looking for companies that look like good value. But what do you think's going on?
So there's a disengagement between the prospects of companies and their prices. They're buoyant because interest rates are low, and so everyone's been lowering their discount rates, and consequently that increases the valuation of shares, particularly for companies where the value is further out. So if the company's not making money today but expected to make money in 10 or 15 years' time, then...
Like a tech stock.
Like a tech stock that's profitless today, they receive the biggest uplift from any decline in interest rates just through the valuation formula. So that's the first thing. The local economy, if we talk about domestic shares, is not strong. So the prospects for companies that don't have offshore exposure, retail exposed stocks, building exposed stocks, for example, the prospects for those businesses aren't good. They're all elevated relative to their prospects because of low interest rates. And so the tension is that even if the growth doesn't catch up, they're still going to remain elevated while interest rates remain low. Having said that though, they're not immune to falls now and again, just as we saw recently with property prices. So we've been in an environment where interest rates are low and falling, and yet property prices still came down. So asset prices aren't immune to falls when interest rates remain low, but the lower interest rates explains why they're elevated today.
Okay, that's a long answer, and I got it, and some people might not get it. So let me cut to the bottom line.
Yeah.
Are you investing confidently at the moment, or are you just picking out the companies that you have confidence that they can weather whatever's going on right now?
Well, our challenge is that our particular style is out of step with current market conditions. So we've underperformed consequently because we're simply not, we're value investors. We're not willing to pay ridiculous prices for stocks. And that means we're holding cash. Cash is a terrible investment. So what we know is that for 6 years up to 2016, we massively outperformed, and for 3 years since, we've underperformed. It's embarrassing to say it, and you know my reputation's attached to it, but we aren't going to change our philosophy. We're going to keep doing what we're doing.
But is there going to be, like, I would have figured, correct me if I'm wrong, after a massive sell-off like the GFC, it's a fantastic time for you because you go looking for companies where the market assessment is ridiculous compared to the value of the company. And that's where you made your name. At this end of the cycle, is there a second coming for a value fund manager like you? And if so, how does it actually come about?
If we drop our discount rates to what the market is willing to accept, we could find things to buy.
But you won't do that.
But we won't do that because we think there's still risk associated with assets. And again, house prices falling in Australia recently is a demonstration of the risk to capital even when interest rates are low. So we're not willing to, we think we look at risk first and we say, do we want to protect our investors from risk? Yes, we do. Of course, we want to preserve their capital. Okay, what sort of rate of return is reasonable for the risk that exists or is inherent in stocks? And that rate is, 8, 9, 10%, not 5, 4, 5, 6, which is what plenty of other people are using.
Could you be helped if the best case scenario comes along? I just recently wrote about it. So
what's the best case scenario?
The best case scenario is, and I don't want you to say it won't happen because I know it's the best case scenario. A Trump trade deal happens, and there's a big reaction both to the market and the economic growth forecast, right? All those things that we've got in this economy now, tax cuts, interest rate cuts, minimum wage rise, the fact that banks are actually lending better than they were 6 months and 12 months ago, a lower dollar. If all those things conspire to create...
Well, they could.
So over 3% growth in 2020, is that going to help a value fund manager make a comeback?
No, it wouldn't. Because
I knew you'd say that.
it wouldn't because what you're describing is what we're seeing. So we're actually seeing the US Federal Reserve and the ECB, the European Central Bank, stimulate because of a fear a fear of downside risks in financial markets, not because the economy justifies it.
So we're not getting the growth part. I know all that stuff I described, but I mean, if the end result of all those things ends up being solid growth in the US, more than we expect now.
Yes.
Better growth in Europe, which is probably harder to believe.
Stimulatory action from central banks and a Trump-Xi deal.
And even a Brexit outcome, which is better than we expect.
That's all positive for equities.
Okay. And so even a value fund manager like you.
But that doesn't bring our valuations up to the share prices.
No. So are you screwed on this cycle?
We're at the moment, it's tough for a value investor. It's tough for all value investors. If you stick to your knitting and do what you say on the label you do, which is value invest, Warren Buffett in 1999 underperformed the Dow Jones by more than 46%. And everyone said he was dried up, he was too old, it was over. You know, value investing doesn't work. And he stuck with it. We're going to stick with it. Yeah.
All right.
It wasn't that long ago, sorry Peter, but it wasn't that long ago. It was October to December. In that October to December quarter, we saw the market come off more than 10%. We saw individual high-flying tech stocks in Australia, the Altiums, the Appens, the Afterpays.
Did you buy any of those then?
They fell 40, 50%. They still weren't cheap enough for us. So, and we believe that that's the kind of environment where we'll do very, very well. And that's what we're positioned for, but it hasn't happened yet.
Yeah, okay. What about the fact that you were worried about house prices? They have come off the boil now. Do you think the worst of the house price falls are over?
Yes. I think we're near the bottom now. I've been advising people, or not advising.
So you're not in the 40% camp?
Oh no, absolutely not. That's crazy. I think those sort of predictions are unjustified. We've got, the interesting thing is, I think we don't see a V-shaped bottom though.
No.
Right? So I think prices are low and they'll stabilise down around these levels and we won't get a V-shaped bottom. And part of the reason I say that is because I don't think the RBA's rate cuts, and I don't think even lowering that 7% or 6 to 7% stressed mortgage test, I don't think that's going to result in a massive tidal wave of buyers for newly constructed houses and apartments. And the reason why that's important is because the residential construction industry employs 3.5% of Australia's workforce. They've got less work on at the moment. And a cut to mortgage rates isn't going to stimulate a lot more activity, which could be down as much as 50% between now and Christmas.
The only thing that might befuddle your predictions is the fact that there's going to be a lot of repair work and even knocking down work because a lot of stuff is going to be really bad.
And if you're right on that, and if houses are, some of these buildings are determined to be uninhabitable and they have to be reconstructed, and I'm not sure who pays for that.
Insurance companies, I presume.
Yeah, maybe, but I'm sure there's some clauses that get them out of some of those. That will determine how much activity there is. So 3.5% of the workforce in residential construction.
Important.
Last year, just as an anecdote, last year builders couldn't find bricklayers, and if they could, they were charging $1.80, $1.90 a brick laid. Now bricklayers are a dime a dozen and they're charging $1.20 a brick laid. So that's just an example of the decline in incomes that tradies are going to experience. So that's why I say there's not going to be a V-shaped bottom. I don't think we're going to see a rapid turnaround.
No.
In some suburbs you will. There's some suburbs already up 10% from the lows.
What about the fact that when you realise that the local market wasn't going to give you the opportunity to apply your trades, searching for intrinsic value companies, you established an overseas fund which did well, but are you in the same sort of situation there?
No, because there's more opportunities.
More opportunities.
The universe is much deeper. And so, we can be more fully invested in our global funds, and that's why the global funds have done very well, because they're more fully invested. Our biggest drag on returns has been cash, and the second biggest has been not being in BHP. Simple as that.
How do you beat the argument, if I'm going to invest in America, I would rather do it with the American fund manager. If I'm investing in Australia, I'd rather be with the Australian fund manager. How do you overcome that particular?
It's easy.
Don't use the word Magellan.
No. I think I'll use Montgomery. I think there are there are more bad managers overseas than there are in Australia.
Okay, good answer.
Simple as that.
Okay, let's get to the important part that people, even though people love hearing what you have to say, Roger. Are there any companies that you like at the moment, either here or overseas, that people should run their eye over?
Oh, I think overseas there's a company called Vivendi. It's the biggest holding in our global fund.
What does it do?
So it owns the Universal Music Group. Now, people might not know Vivendi, but they may know the Universal Music Group. So Universal Music Group owns the rights to the Beatles, Song Library, Dire Straits, just about anyone who's everyone. They've got the Song Library. They've got a 30 to 40% market share globally. Now, what's interesting is the world changed dramatically when we went from the physical delivery of music through CDs and prior to that vinyl and tapes and so on, to digital through Spotify, Apple iTunes and so on. So what's actually interesting is that you don't get as much money for a song when you play it to somebody digitally, but spending globally on digital music far exceeds even the peak of spending on physical music. So more money is being made by companies delivering digital music than was ever made delivering physical music. The other thing is Universal Music Group used to make a 10% margin on their CDs when music was delivered physically, because you think about it, they've got to burn the CD, they've got to print the CD, they've got to package it up, they've got to put it on a pallet, send it out, and then they've got to ship it, pay for shipping and logistics as well. All that's done for them by Spotify and iTunes, for example.
And I guess the movie yesterday is going to help them as well, because it reminds people how great the Beatles songs were.
Yeah, indeed, and that's a great anecdote. And then to upload a song costs nothing. To distribute it, the expenses, the marketing costs are paid by Spotify. And so this is a company that's worth significantly more than where it's trading. And its margins, it will sell more. So its geography, as Spotify opens in new geographies and penetrates more deeply into existing geographies, its revenue is going to go up and it's going to make a higher margin.
Okay, before we go, I always remember you telling me a story about this company I never heard of before that used to play around with little boards and chips and things like that. It was a company that actually did the boards.
Altium.
Altium?
Yeah.
An unknown company. Do you still hold Altium?
No, we sold it a while ago. Wish we still had it.
Yeah, you certainly picked that in the early days.
We did well owning it, and we've made money on it.
But the market didn't believe the story for a long time.
Not for a long time.
Eventually they did. Yeah.
And now they overbelieve, arguably. There are companies like Appen, for example. Altium's another one. WiseTech. I'll give you an example. WiseTech is a brilliant business, high quality business. We'd love to own it. It's got 80% market share in freight forwarders, logistics companies, and 100% market share amongst freight forwarders for their software. They're an incredible business, but they're on an $8.5 billion market cap, which is the same as Qantas, but they only have revenue that's 2% of Qantas's revenue. So it's just
buy them after a crash.
Oh, definitely. There's definite opportunities in those companies, but not at these prices.
Okay, one last question, and that a company like Zip. Now, Afterpay obviously has gone through the roof. Zip is a more old-fashioned pedestrian version of Afterpay. Have you run your eye over Zip?
Yeah, look, we don't think there's any value in those companies at the moment. What I'm still trying to get my head around is to what extent the belief that millennials are different in terms of their credit experience. When I talk about credit experience, I mean their ability to default. The market believes that they're somehow different to everybody else in history. That they're not going to default and they're always going to be able to pay these things off. And I'm just not sure the market's got that right.
Roger Montgomery, you might be getting old after all these years. Thanks for joining us on the program.
Always a pleasure, Peter. Thank you.
That's Roger Montgomery from Montgomery Investment Management.